An important development in the financial industry in recent years has been the growth of sustainable investing. But what exactly does that mean? Well, here's Dan Lefkovitz from Morningstar.
We define sustainable investing rather broadly. We consider it to be a long-term investment approach that incorporates environmental, social, and governance criteria, ESG. And it can range from sort of old-fashioned exclusionary screening, like you might have seen in an ethical fund or a socially responsible fund, avoiding stocks of alcohol, tobacco, or gambling companies, perhaps coal. It can also just be integrating ESG factors into the overall investment analysis. And that sort of integration is actually the most popular form of sustainable investing today.
Passively managed funds are cost-effective, but by definition, they invest in the whole market. So, is there a conflict between passive investing and sustainability?
It's interesting. You might think that, but in fact, we've recently seen quite the opposite. So we've seen big passive investment managers, the likes of BlackRock, Vanguard, and State Street, become a lot more active with the companies that they own simply because they're replicating an index. Now you're actually seeing passive investment managers who have to own these companies and feel like they're sort of stuck in a long-term relationship with no option for divorce. Be more active when it comes to their ownership.
If you want to combine passive investing with sustainable investing, there are plenty of funds out there, particularly exchange-traded funds, which effectively do both.
We actually think that sustainable investing lends itself very well to index funds and to exchange-traded funds. The kinds of positive and negative screens that are typically employed with sustainable investing actually fit very well in index and exchange-traded fund format. There also seems to be an alignment between the demographic that sustainability appeals to and the exchange-traded fund. Younger investors like sustainability, and they also like exchange-traded funds.
Of course, all investors ultimately are looking for good returns. So, is there a price to pay for investing with your conscience?
The number one frequently asked question we get about sustainable investing is, do you sacrifice returns if you are investing sustainably? And interestingly, maybe in theory, if you're limiting your universe and not investing in certain companies because they're not sustainable, that would be limiting. But in practice, our data show that sustainable funds perform on par with their non-sustainable counterparts, and there's even some evidence to show that sustainable investing leads you to companies that are poised for outperformance.
That's it. Thank you to Dan Lefkovitz from Morningstar.